Markets crash, panic spreads, and while most people are selling in fear, the wealthy are quietly getting richer. What do they know that you don't? Today, we're exposing how bear markets work and why they're secretly the biggest wealth-building opportunities in history. Welcome back to Money Mystery, the channel where we uncover the hidden truths about wealth, finance, and the systems designed to keep you in the dark. In today's video, we're diving deep into the concept of a bear market, what it really means, how it impacts your money, and most importantly, how the elite use it to multiply their wealth while the rest panic and sell. Stick around, because by the end of this video, you'll know how to spot a bear market, how to survive it, and how to turn it into your financial advantage. What is a bear market? A bear market is when the stock market drops 20% or more from its recent highs. It usually comes with fear, uncertainty, and a lot of bad headlines. But here's the twist. It's not the end of the world. It's part of the cycle. Every 3 to 6 years, markets correct themselves. Bear markets are natural and historically temporary. Some of the best investments in history were made during bear markets. The rich understand this because they don't see crashes as endings. They see them as discount seasons. How the wealthy prepare for bear markets. While the average investor panics and pulls out money, the wealthy are strategic. How they prepare. Cash reserves. They keep liquidity ready to buy when prices drop. Diversified portfolios, not all in tech or crypto, spread across sectors. Long-term mindset. They don't look at 6 months, they look at 10 years. Example, during the 2008 crisis, Warren Buffett invested billions while everyone else sold at a loss. Be fearful when others are greedy, and greedy when others are fearful. Buffett. How you can take advantage of a bear market. This is where most people miss out. You don't need to be a millionaire to play smart in a downturn. Here's what to do. Don't panic sell. Locking in losses only helps the rich buy cheap. Use dollar cost averaging. Invest fixed amounts regularly. Focus on fundamentals. Buy companies with strong financials, not hype. Think long-term. Bear markets don't last forever. Recovery always comes. Bonus tip, invest in ETFs or index funds tracking the S&P 500 or NASDAQ. Low-cost, diversified, and historically resilient. The psychology of fear and opportunity. Bear markets aren't just financial events, they're psychological traps. The media will scream, "This is it. Get out now." Your brain will say, "What if they're right?" But look at the history. 2000 tech crash, recovery. 2008 housing collapse, recovery. 2020 pandemic crash, recovery. And boom. The people who win are those who keep calm, stick to their plan, and understand the long game. Bear markets test your mindset more than your money. They separate emotional investors from educated ones. The wealthy use these downturns to grow their empires. You can too, if you stay smart, stay steady, and invest with intention. Have you ever made a financial decision during a market crash that you regret, or one that you're proud of? Share your experience in the comments. We want to hear your story. And if you're ready to keep learning the secrets behind the system, hit that subscribe button, turn on notifications, and join us on the journey to financial freedom. This is Money Mystery, where the truth about money is finally revealed.